Why banks fear people with $20,000 saved. What if I told you that having just $20,000 in savings could make banks uncomfortable?
It sounds surprising, right? If you're a retiree, a working adult, or someone planning financial security for your family, this is something you need to understand. Banks don't openly say it, but their system depends on people not saving enough. When you reach this level of savings, your behavior changes, and that affects how banks make money. In this video, we'll uncover the hidden reasons behind this and explain why your financial independence matters more than you think. Stay with us, because this could change how you manage your money. 1. You become less dependent on loans. When you have $20,000 saved, you don't need to rely on loans for emergencies or sudden expenses. This independence reduces your need for credit cards, personal loans, or overdrafts. Banks earn significant profits from interest on these products, so when you avoid borrowing, they lose a steady income stream. Many people fall into debt cycles because they lack savings, which benefits banks. Having savings breaks that cycle. It gives you control and peace of mind. To maintain this advantage, focus on building an emergency fund and avoid unnecessary borrowing whenever possible, even when credit options are easily available. 2. You question bank fees more. PE.Opal with savings tend to pay closer attention to their money, including bank fees. Monthly charges, hidden deductions, and transaction costs become more noticeable when you are financially aware. Banks often rely on customers ignoring small fees, which add up over time. When you have $20,000 saved, you're more likely to challenge these charges or switch to better accounts. This behavior reduces bank profits. It's important to regularly review your statements, compare banking options, and avoid unnecessary fees. Staying informed ensures that your money continues to grow instead of slowly being reduced by unnoticed charges. 3. You start investing instead of saving. Once your savings reach a certain level, like $20,000, you may begin exploring investments such as stocks, mutual funds, or real estate. This shift moves your money away from traditional bank savings accounts, where banks use your deposits to generate profit. When funds leave these accounts, banks have fewer resources to lend. Investing allows your money to grow faster than standard interest rates. To make the most of this, educate yourself about safe investment options and consider diversifying your portfolio. Smart investing helps you build wealth while reducing reliance on low-interest bank accounts. 4. You are harder to influence financially. Banks often promote credit products, insurance plans, and financial services that generate profit for them. However, when you have solid savings, you are less likely to accept these offers without careful thought. You can evaluate options calmly instead of making decisions out of urgency. This reduces impulsive financial behavior, which banks sometimes benefit from. Being financially stable gives you the confidence to say no to unnecessary products. To stay in control, always research before committing to financial offers and focus only on what aligns with your long-term goals rather than short-term convenience. 5. You avoid high-interest debt traps. Savings act as a protective shield against high-interest debt, such as credit card balances and payday loans. Without savings, people often rely on these expensive options during emergencies. Banks and financial institutions earn large profits from these interest payments. When you have $20,000 saved, you can cover unexpected costs without falling into debt traps. This reduces the bank's ability to earn from your financial struggles. To maintain this advantage, prioritize saving consistently and use credit responsibly. Avoid carrying balances on high-interest accounts and pay off any existing debts as quickly as possible. 6. You gain financial confidence. Having $20,000 saved builds confidence in your financial decisions. You feel more secure and less stressed about unexpected situations. This confidence changes how you interact with banks and financial institutions. Instead of feeling pressured, you take control of your financial choices. Banks prefer customers who feel uncertain because they are more likely to accept offers without question. Confidence allows you to negotiate better terms and make smarter decisions. To strengthen this mindset, keep track of your savings goals and celebrate milestones. Financial confidence leads to long-term stability and reduces dependence on external financial support. 7. You can switch banks easily. When you have savings, you are not tied to one bank out of necessity. You can move your money to institutions offering better interest rates, lower fees, or improved services. This flexibility creates competition among banks, which they may not prefer. Customers without savings often stay with the same bank due to convenience or lack of options. Having $20,000 gives you the freedom to choose what works best for you. To take advantage of this, regularly compare banking services, and don't hesitate to switch if you find better benefits elsewhere. Your money should always work in your favor. 8. You think long-term, not short-term. People with savings tend to focus on long-term financial goals rather than immediate needs. This mindset reduces impulsive spending and borrowing. Banks often benefit from short-term financial decisions, such as using credit for unnecessary purchases. When you think long-term, you prioritize saving, investing, and financial security. This reduces opportunities for banks to earn from your short-term financial gaps. To build this habit, set clear financial goals, such as retirement planning or emergency funds. Review your progress regularly and adjust your strategy as needed to ensure steady financial growth and independence. 9. You reduce financial stress. Savings provide a sense of security that reduces financial stress and anxiety. Without savings, unexpected expenses can create panic and force quick decisions, often involving borrowing. Banks benefit when people are under financial pressure because they are more likely to accept loans or credit offers. Having $20,000 saved allows you to handle challenges calmly. This emotional stability improves your overall decision-making. To maintain low stress, continue building your savings and avoid unnecessary expenses. Financial peace of mind is one of the most valuable benefits of having a strong savings foundation. 10. You build true financial independence. Ultimately, having $20,000 saved is a step toward financial independence. It means you are less reliant on banks, loans, and external support. This independence shifts control from financial institutions back to you. Banks prefer customers who depend on their services for survival, not those who can manage without them. Building independence requires discipline, consistent saving, and smart financial planning. Continue to grow your savings, explore investment opportunities, and educate yourself about money management. The more independent you become, the more control you have over your financial future and life decisions. In the end, having $20,000 saved is not just about money, it's about control, confidence, and freedom. While banks may not openly admit it, financially independent individuals change the system by relying less on debt and more on smart decisions. If you or your loved ones are working toward financial security, this is your sign to stay consistent and disciplined. Start saving, stay informed, and protect your future. Your financial health matters not just to you, but to your family as well. If you found this helpful, don't forget to like, share, and subscribe for more valuable insights.